Welcome everyone to this Belgium meetup on the pension savings plans in Belgium. And for this meetup, we welcome David, David Liegeois. He's a member of the financial independence community in Belgium, I'm guessing both on Facebook and on Reddit and different places. And we met in person a year and a half ago, I think. And at that time, you were already telling me that you were doing some research on the pension savings plan to compare them with index investing, and that you came to conclusions that were a bit different from what most of the community was saying. So first of all, David, welcome.
Yes, thank you.
Thanks for all the work you've done so far. You've worked on this model for a while, and the conclusions that you came to are quite different from some of the things that we know or that we think we know as part of the community, obviously depending on specific cases, right? And so today I've invited David to come and share his understanding of the pension savings plan and to share his model and to share some of the results that he's reached, some of which you might have already seen in the article that's on the website. And certainly the idea today is for David to share his work and to seek feedback, right? So the whole purpose of us doing this work here is to find ways to help you, everyone basically in the community, make decisions on whether investing in those pension savings plans as they are today in Belgium is worth it alongside investing in index funds. I guess something that's quite important is that we assume that the people have that you who is watching this right now, that you already know how to invest in index funds, and that you're wondering whether it makes sense to also invest in pension savings plans, because basically index investing through index ETFs is already so good that it's actually very hard to beat. And as we know, most actively managed funds sold by banks just can't compete long-term with index funds. But with pension savings plan, that might be a bit different because of some of the tax advantages, for example, and how we use some savings that we can make from those tax deductions. And so that's the whole point of David's work, is to see if as an index investor, this is worth it for you. Now, if you're not investing in index funds, certainly you should learn because that's what we do mostly in the community. It's one of the things that we do a lot. It's the one thing I teach to a lot of people. And so if you're looking for information on how to invest in index funds, optimize for Belgian taxes, and do it in a very simple way and effective way, then check the website and check the free workshop that's on the website, because you will find everything there. Right, so that's just a bit of an introduction. David, anything else you want to say before starting?
No, I think it's a good resume of the situation.
Awesome. Maybe before you start, would you mind telling people what's your background and what gives you, interesting insights into, the work you've done here, maybe?
So my name is David Liegeois. And 2.5 years ago, I quit my previous job where I was developing tools for banks and especially for investment and securities. I work as a financial IT analyst. And if you look through the community of FIRE, you will see that a lot of people are writing in articles, in forums, that it's not worth to invest in pension savings in comparisons to low-cost index funds. And so I try myself to look with details if it was true. I make a model, and my conclusion was a little bit different. I'm not saying that what people say are wrong, but you can give some nuances, and through some parameters, it might be more interesting to invest also through a pension saving plan.
Yes.
So I will just share, if you see my screen here, it's just a talk in Reddit of today. I don't know if the person who writes this talk look at my article, but for example, you can see a person who was writing, okay, if you invest in a pension savings plans and with the tax and on 40 years, you will get 22%. So it will give you 0.35% per year. So what's a scam? And I think it's very difficult to take this answer for yourself if you don't have all the parameters before making any conclusion. Like, so just to give some context, so we'll speak about pension savings. So, but first, what is the pension system in Belgium? So in Belgium, we have 4 pillars. The first one is the legal pension, the first pillar. It's an allocations provided by the state. It will depend on your income, the number of years you have worked, and your status, if you are an employee, a freelance, etc. The second pillar is the complementary pension. There is different kind of complementary pensions, group insurance. That's more for employees, and for freelance, you have more PLCI, EIP, CPTI. It's an acronym in French, VPZ, IPT, and POZ in Netherlands. And it's provided by your employer or by yourself if you're a freelancer, and it's give you a tax advantage to participate in this complementary pension. The third pillar, and which is the subject of these presentations, it's a tax advantaged savings. So you will put some money in a plan, and you will hope that will bring you more value at the end. The fourth pillar, it's the rest, which are not tax advantages. So all the savings, the investment, the real estate, investment in gold, etc. The issue with this fourth pillars is that it's not tax advantageous, so you don't have any, the state will not help you to invest through this investment. So it's to you to decide it what's the best for your future. So for the third pillar, there is 2 possibilities that you can combine. The first one is the long-term savings. It's an insurance contract. Until last year, it was depending on Belgium regions because you have a bracket where you also put some amount of money from a mortgage, and it's linked to your income. And the second one, which is the subject of tonight, is the pension savings through banks or through insurance. If you took an insurance contract, you have 3 possibilities. Branch 21, TAC in FinTech. It's the investment with a known return. And you can have also what we call the PB, participation bénéficiaire, or yeah, it's participation bénéficiaire. You have the branch 23, TAC 3 and FinTech, which is the investment through a fund, and the branch 44, branch 44, TAC 44, which is a mix of 21 and 23. And then you have the bank funds that I will use in the following simulations. So I have a questions for you. What do you think is more profitable and why? Investing through a pension saving fund or through a portfolio of low-cost index funds? Maybe you can answer and we'll see in the chat.
Yeah, so what do you think is more profitable? A pension savings fund or a portfolio of low-cost index funds? Okay, so we see the first answers coming in, and it's everyone's responding index funds, ETFs.
ETFs. Okay.
Someone has a bit more nuanced response. It depends on
Yes.
the age when you start pension savings funds and the expense ratio of both.
So there is, it's my personal opinion, but there is no correct answer to these questions. It will depends really on your personal situation. So like I said, I develop a model, and in the simulation I will present you, there is 3 assumptions. The first one is that you will reinvest your tax advantages. The second one is that in the simulation I will present, I will stay at the same level of risk. So the allocations of bond and stock will be the same. I know that when you start at investing at 25, it makes sense to not invest in bonds, but there is people who cannot afford to see their portfolio fluctuating a lot. And so I prefer presenting situations where we have the same level of risk. And finally, at the end of the simulation, I will sell the portfolio of low-cost index funds because I really want to see what is the net result of the situation and not what you see on your online broker status.
Yeah, so we want to compare the results net of taxes at the end.
Yes.
And transaction costs. Okay.
So I don't know if you have the time to download the tool.
Maybe we can ask also. So can you tell us in the chat if you have downloaded the tool and tried to work out your own personal situation? So you can find the tool. It's available on the website of Fire Belgium in the article. It's one of the links at the top of the article. You can make a copy, either you download the spreadsheet to your computer or you make a copy to your own Google Drive. So most people say that they haven't.
So I will present it so you can download it.
Some people say they've downloaded but not sure how to use it. Okay, so that's what we're gonna do. Awesome.
So first, I will present you all the assumptions, parameters that I will use. So the first one is the age where I will start the simulations at 25 years old. So it will be 40 years of deposits. The second one is the amount I will put. In Belgium, for pension savings, you have 2 possibilities. The first one is until 1,020 euros, where you will get a tax advantage of 30%, or until 1,310 euros, where you will have only 25% of tax advantage. Then you have the entry fees, which will vary between 0 and 3%. The one I use is at 0% of entry fees, which is quite nice, because if with 3% you will lose some return at the end. The return or the yield of pension saving, I see a lot of different yield. I take the one from the pension savings ARP from Argenta Bank, and between beginning of 2004 and the end of 2023, it has a yield of 6.28%. I also include the virtual taxations of 4.75%. So for the banks, you will be taxed at a virtual return of 4.75%. For insurance contracts, it will be at the real return you will get. The tax is 8%. So with 1,020 euros, you will get a tax deduction of 30%. You also need your municipal tax because it will be increased a little bit, the tax advantage. Then one big important is if you are an employee, you can benefit in some companies from a flex income plan.
David, maybe before we continue, Can we explain a bit more how the taxes are applied and what they mean? Like the tax. So on line number 5, this is just to clarify for those who are not aware. This is because basically the way the taxes on branch 23 and bank funds is applied, I think, is that they assume a continuous growth of the investment at 4.75% per year, right?
Yes, they capitalize each year at 4.75%.
So irrespective of the actual performance, this is what they will assume is the return.
Yes.
Okay, and then the tax épargne-pension. So this is line number 6. 8%. Yes. This is the tax at the end when we recover all the assets. So, is that right?
So the banks will, let's say you have 40 years, they will take each deposit you make and they will make it grow at 4.75% per year.
Yeah.
Until you reach 60. Mm-hmm. And then they get a base, an amount of money on which they will take 8% of that.
And this is when you reach 60.
Yes.
And they take 8% at 60, and then.
And then you can continue until 65 for the moment, and it's tax-free. So you will continue to make deposits. You can have the tax advantage, but you will not be taxed anymore.
Okay. And so the deduction fiscal, this is line number 7. And this is what?
That's the 30% you will get
tax
from
deduction.
Tax deduction, yes.
And this is something that basically when you contribute to these plans, then the following year you recover part of it through tax declaration.
Yes, you will normally it's automatic, but you will get in your tax declarations a line where you have invested the money.
Okay. Okay, I think that's and then the communal tax. So this is depending on where you live, the city you live in.
Yeah,
this is applied where and when?
In your tax declaration, so it will increase a little bit the 30%. So it's not really
additional deductions.
Yeah. So here you will get 306 euros, and in fact you will get a little bit more because of you will avoid also to pay 5.7%.
Yes, and then in some cities this tax is higher, and some cities this tax is lower. Okay.
Yes, if you live in Knock, you don't have any tax to pay.
There's no tax deduction additional. Okay, it's only 30%.
So the flex income plan, so it's a way for employees to pay less tax, and it's possible to put the amount of money you have paid last year for your pension savings, and you will get also a sort of tax deduction. I'm not an expert in a flex income plan, but in my case, in the flex income plan, I have a convection factor that will in fact reduce the amount of money they will remove from my plan. And that's it's part of a parameter to compute the tax advantage. You will also need the maximum tax bracket in which you are when you have your income. If you are at 50%, but it can be 45, 40, or 25%. And with the different parameters, I get a tax advantage of 123 euros in addition of the 30% and the municipality tax.
Can we maybe check something? So for the people who are in the audience, can you tell us if you do have this plan cafeteria is something you benefit from? It'd be interesting to see if there's anyone who has this and how common it is. So it's the case for Thomas. And it's not the case for many other people.
Yeah. If you're a freelancer, if independent, I don't think you can.
Yeah, or working for a small company who might not have this setup.
Yes.
Okay. Okay, it's good to know. It's good to know. So this is it's an additional benefit for people who have this.
Yeah. In this case, you just put no and.
Yeah.
So that's the parameters for pension savings. And now for ETFs. So you have a tax on the stock market. I will take the 0.12%, which is the lowest. The cost for the broker, I took €1. I think Liegeois, Trade Republic, it's about the amount you will pay. For Belgium broker, I think it will be a little bit more. Then, if you want to invest in some bonds to decrease the volatility of your portfolio, I will take 30%. Why 30%? Because it's the minimum percent of bonds that the pension saving funds must have. So I will take this one. I will take a return for bonds of 4%. We look at the last 20 years. We were at 2.3%. I took 4% to take some margin. For the stocks, I took a yield of 9%. We are around 8.3 for the last 20 years. In my simulations, I took some, I was more conservative for the pension savings, a little bit more nice, more kind for the investment in ETF. So with 30% at 4% and 9% for the stock, the portfolio will give 7.5% each year return. If you invest in a bond ETF, you will have to pay what we call the tax renders, the sort of tax on capital gains for bonds. Here you have three choices.
Yeah, you know, David, I don't know if we need to go into that much details for the bond ETF percentage.
Yeah. Maybe I will start because some people doesn't want to invest in bonds or maybe later. So I think it's interesting to just show them the possibility.
Okay, go ahead and explain a little bit. It's just that it's maybe the bit more complicated part of your model. Okay.
Yes. So you have three choices for bonds. The first one is, I say, at the start of the simulation, so at 25, I will invest for 30% of bonds. That's what I took as assumptions for the simulation. To show you. So in the spreadsheet bonds, you have 30%, which give a yield for the portfolio of 7.5%. If you choose to start only at a later in the simulations, the part of the bonds, you put the number 2 and you say, for example, I will start at 40 years. Then you will be at 0% of bond allocations until 40 years, and at 40 you will start at 30%. Of course, the yield of your portfolio will be higher at the beginning of the simulations and lower at the end.
Can you maybe zoom a bit into your spreadsheet? Yeah. Thank you. Okay, let's go back to assumptions. Yeah, sorry. Carry on, and then I will explain a bit more as well.
And the last one is you decided, for example, to be at 50 years at 30% and beginning at 40. So you will reach 30% here at 50 by starting to invest in bonds at 40. And then through a linear increase, you will reach 30% at 50 years by starting at 40.
Okay, so maybe just to give a bit more, or at least my perspective on how you've built this. You've selected one pension savings plan, which is this ARPE.
Yes.
Right. It's a good one because it has low entry fees, actually 0, and it's had a high return over the past 20 years.
Yes.
But you selected this one because it's a really good one based on past data, right?
Yes.
We don't know if it's going to continue doing so, but certainly in
No.
the past it's been pretty good.
Yes.
And then you also developed a theoretical portfolio of index funds, of ETFs, with 30% bonds, with basically to compare something that has a similar volatility to the pension plan, which would technically have also 30%.
Yes.
And then
I think it's even 35% for moment.
So then you found the returns of bonds and the returns of MSCI World Index for the past 20 years using backtests from Curvo.
Yes.
To be 2.3% for bonds per year and 8.29% per year for stocks. But then in your model, you've used 4 and 9. So you've rounded it up massively. You've basically given at least, probably an extra percent, right, long term.
Yeah, because I think that 6.28 was really good. So I would say, okay, maybe there will be some luck from the portfolio manager. And let's give some credits to index funds.
So I guess this is because you've selected, based on historical data, the bank fund or the pension plan that had the best results. And to compensate for that, you're maybe then going to assume that the stock market would do more than what it has actually done in the past 20 years.
Yeah.
So I think, in terms of how we build this comparison, this is one area that we've discussed already before, no? But that probably would be worth, well, it's important for people who are looking at this to understand how you've made those choices. But then it's also up to everyone to adapt those assumptions to the personal situation. But certainly the choice of return for bonds and stocks, you've taken you've made the decision to basically increase this, right? To be, basically on both sides, you've made choices so that you have returns that are probably higher than the average, essentially, right? Because you've picked better than average pension plan, and you've picked better than average or better than historical average returns for stocks and bonds. So maybe one way of then presenting this would be to take average returns on both sides. No, that would be another way of comparing something. Anyway, so this is just to clarify for people who are listening and watching this. We obviously cannot use all the returns from all the pension plans. And we could use the actual returns for bonds and stocks. But I think that when you were doing so, then it was showing that the pension plan was really, 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 really good, right? So the comparison, I would imagine that when you were doing this, then it felt like it wasn't fair. Is that right or not?
It's really difficult to predict the future. I took one fund. Yes, it's the best one, but a person who had invested in this pension fund 20 years ago would have a return of 6.28%. So
with this pension fund, but they wouldn't know if this one would do this, right?
no, indeed.
People would have picked based on some other factors because they don't know actual returns in the future.
Yeah.
But so, yeah, that is one challenge in every time we do this kind of comparison. We're going to have to pick some kind of past data. So anyway, so this is important for anyone who's looking at this, right? Just be mindful that for both the pension plan and the ETFs, it's basically, it's like an optimistic returns that we have here, right? Okay, I think that we can carry on. Now, another aspect of this, I guess, is that you give the choice to the user to put bonds in the portfolio of ETFs for the comparison. And you also give the option to have bonds be at a fixed asset allocation throughout the investment, or with asset allocation that changes over time, with two different scenarios. One where it goes from 0 to the target asset allocation at a specific age. That would be option 2, right, on line 20. And then you also give the option for people to have a glide path between a certain asset allocation and a different asset allocation after a certain number, like at a different age, right? So, for example, going from 20 to 30, or from 0 to 30%, sorry, between the age of 40 and 50, which is what you were showing us earlier. Is that right?
Yes.
Okay. All right. So just want to make it super clear, right? So the people who are watching this later, if they don't understand, then they have the explanation twice now. All right, let's carry on. This is very good.
Okay. So I have presented the different parameters, and now I will go through the simulations. The first simulation, there is two simulations. The first one is without reinvesting the tax advantages, and the second one is with the reinvestment of the tax advantages. So if we took the spreadsheet without reinvesting, so we have the years in which you will make a deposit. You start by investing an amount of money. From column C, I will increase maybe the from column C to column H is the pension savings, and from I to column O it's for ETFs. So it's the column C is the net investment. If you have an entry fees, it will be decreasing the amount of money. On column D, it's simply the value of your portfolio at the beginning of the year. So generally, it's the amount you deposit plus the amount at the end of last year. Then you have on column E the value at the end of the year. It's the value of the portfolio at the beginning of the year times 1 plus the yield, assumed yield. On column F, it's the virtual value of your portfolio for the tax computing. So you see here we assume 6.28% in comparison with 4.75. So it increased less quicker than the real value. And on column G, it's simply the tax advantage you will get. So if you invest at the beginning of, let's say this year in 24, I assume that you will only receive the tax advantages at the end of years of the next year, so at the end of 25. It's in general what you would get, and the tax declarations is to be filled on the next year, and in general, if you receive some things, it's in November or December. And so on column H, it's the amount for each year, what you will get. So after, at the age of 60, you will have to pay the tax of 8%. Here, I took the assumption that you were born on 31 December. So you will have, when you're born at the end of the year, you are penalized at the age of 60 because in general, we advise people during this precise year to invest the money after they have paid their tax. So it's one part, and the second part is that if you're born the 1st January, you will not capitalize at all for this year in comparison with being born later when you will be capitalized at a percentage of 4.75. Proportionally, also, if you are born on 1st July, it will be half of that. So you will pay in the simulations a tax at the end of 7.4 thousand euro. It could be a little bit less, like I said, I took conservative assumptions. For the ETFs, no, but you have to pay the tax on transaction and the broker. So it will reduce a little bit the net amount you can invest. On column J, it's an amount for the rebalancing in case of when you invest in ETFs, it's not enough, the amount you can invest is not enough to reallocate to the portion of bond and stock you want. On column K, it's the amount on bonds you invest. It will be useful to compute the reindeer tax. On column L, it's the same as for the pension saving. So it's the value of your portfolio at the beginning of the year. Column M at the end, it's the value of bonds. Column N is the value of your portfolio at the end of the year. And column O, it's the value of the bonds at the end of the year. In these simulations, I look at the difference between the value of your portfolio between the stock, the ETFs and the pension savings, and I see at 65 years that you have a difference of about 57,000 euros in favor of ETFs. So here we see that indeed, if you don't reinvest your tax advantages, it's better to invest in stock and bonds through ETFs.
Yeah, so let's clarify those two scenarios. For people who are obviously, I mean, it makes quite a bit of sense. Now you are investing in those savings plans. There's a tax advantage that is basically reimbursed to you the following year. And what you were saying, David, is that in the other analysis and simulations on this topic done by other people in the community and on different websites, you've seen them basically not recover this tax advantage, but simply say that they were reinvesting it in, well, I think my understanding is that they say that this tax advantage is recovered the following year and invested in the savings plan.
Yes, in some of them, they use it to say, okay, I have to add less amounts to invest the next year.
Yeah, so it's as if they were basically keeping it as cash, right?
Yes.
Not really reinvesting, which in your case, what you want to do in the, well, we will get to the next scenario, but basically for people who are already investing in index funds, which is, it seems it's the majority of people here today, the idea would be to obviously recover this tax advantage deduction and use that freed up cash to invest in index ETFs alongside the pension plan, right?
Yes.
Okay, now let's look at your graph here, yeah?
So here you can see that at the beginning, the tax advantage take the lead, but after, let's say, 25 years, 20 years more or less, then the fact that it's a better investment in ETFs because you don't reinvest your tax advantages, so it loses, in fact, a sort of yield through time. If you receive 500 euro, this year it's 500 euro, but if you keep it for 20 years, the return on 20 years is far less.
Yeah, so this makes sense, right? So as we are at the beginning of the pension savings plan, the 30% tax deduction is interesting and makes that more interesting than index funds. But as time passes, this tax advantage, which is fixed each year, basically is not enough to cover the difference in performance and fees between the ETF portfolio and the savings plan, because savings plan basically is more expensive to run and performs a little less. And so over time, the tax advantage, which is quite good at the beginning of the plan, the longer you invest in this, basically, the less interesting it is.
Has someone hearing me?
Hey, I was just disconnected. Is everything okay? Did you get disconnected too?
No.
It's just me then.
Okay.
Okay. All right, I'm back. Carry on.
I will repeat. So with the reinvestment, so the beginning is the same. So you invest in pension savings plans. The parameter are the same. you will pay at 60 the 8% tax at a 4.74% yield. But for your tax advantages, you will reinvest it in a portfolio of ETFs 2 years later. And you will keep exactly the same as if you invest directly the amount you put in the pension savings plans, and you do exactly the same. And what we can look is at this moment in this simulation, so with the same level of risk, with 123 euro of flex in a flex income plan, you can reach an amount that is greater than investing in a pension in a ETFs by about 22,000 euros.
Okay, so this is the interesting part here, right? You've modeled the comparison without reinvesting the tax advantage, and then you've modeled the same scenario, but when the people basically gets the tax advantage and reinvests in a portfolio of index funds, like we defined at the beginning, and without reinvestment, it's a loss of 55,000. No, was it 57?
57,000.
And with reinvestment, then it's a gain of 22,000 compared to like basically adding the pension savings plan provides an additional 22,000 at the very end. Is that right?
Yes.
Okay.
So that's the so in the the first two spreadsheets, the next one is a sort of view of what will bring each year of deposit in comparison between if you compare pension savings and ETFs. So if I put 1,020 euro at 80, I could expect to have an amount of 18,600 euro in comparison with an ETF, where I could have 32,200 euros. And what I can see is with the same parameters, it's at about 53 years old that it starts to be interesting to invest in pension savings plans. If I look now with the
so this is for the scenario where we're not reinvesting.
Indeed, yes.
Right. And what you're looking at here is like, from what age is it interesting to start the pension savings plan?
Yes.
Or like for each age, in which of those ages does it make sense to be investing in savings plan? And it looks like if you're very young, then it's a very big no-no in this case. But from 53, then it becomes a positive decision.
Yes, indeed. And simply because if you don't reinvest, the closer you are of 60, the 65, the better the return of the tax advantage will be.
Yeah, so basically at 53, the tax advantage still carries enough weight that the lower performance and higher fees of the savings plan does not counterbalance that over the following basically 7 years.
Indeed.
Okay. Because it's short enough, then the tax advantage is interesting.
Yes. So here you see for pension savings plans, the closer you are from 60, the better the return comes. From ETFs, it's the opposite. When you start at 18, if you make a deposit at 18, the tax and the costs are almost zero compared if you invest for only 2 years, for example, when you have a slight decrease of the return.
Yeah, and just to clarify here, this is not investment returns for the long term. This is just the difference between the pension savings plan and ETFs for that specific year. So it's this 1 year benefit. So I wouldn't call this a return. I would call this, an advantage of one over the other, right? For that specific year. It's not like investment returns. That's not what we're talking about here.
It's the expected return at the age of of a deposit at a selected year.
Yes, okay, but it's not something to expect year after year, is what I'm saying.
No.
Yeah, this graph is a little bit misleading if we don't really understand what it means. And like certainly those two sheets here, right, are not so simple to understand what they mean. So, but they're good for the analysis and what we're trying to do. So I think the main takeaway here is that without reinvesting, with the assumptions that we made at the beginning, which you remember were very optimistic for both the pension savings plan and for ETFs, right? With those assumptions that are, in a way, they're not exactly realistic. So that's one thing to keep in mind. In those specific scenarios with the cafeteria plan, right?
Yes.
Then starting at 53 makes sense. Before that, you don't want to start, right? But starting at 53 makes sense. Now, with the scenario where we actually do reinvest
In the past,
the tax advantages from the beginning, then
indeed,
that's a different story.
Yeah, here we see that at 27, you start to become positive. So in these simulations with these parameters, you can expect it's at 27 that you should start to take the more in a more profitable way. And we see indeed that's because of the reinvestment of the tax advantages, the return each year become far greater.
Right. So in this scenario, with reinvesting everything, it looks like starting at what age then?
27.
At 27 becomes, from 27 onward, then investing in pension savings plan with this scenario then is interesting.
Yes.
From a return perspective, because there's obviously other aspects to look at. Okay, so this is quite striking, right? Because this is very different from what we've seen in the community before. Now, I think, what else do you want to share here, David?
So for me, the conclusion of this model, and of course we can discuss about if it's a good model or not, of what you think would be
maybe we do that. You also did run the model with the same assumptions as Kurvo, for example, right?
Yes.
Who arrives to the conclusion that investing in pension savings plan is not interesting in most cases. And you've compared and you've reached very similar results. So in terms of, from that perspective, your model gives results that are in line with the other models out there, and probably you are more accurate in some elements of it, right?
Yes, in really small details.
But generally, it's in line when we use the same assumptions as them.
Yes.
Without the reinvestment, and when we do with reinvestment, which
of course we differ completely because they didn't reinvest their tax advantage.
So that may be something to discuss with them, right? Like why do they not do that? It's because for index investors, it would make sense to reinvest the tax advantage since we're already investing in index funds anyway. So it happens automatically, almost, right? Because when we have savings, we invest them. So I guess we have you and me. We could write to them and say, ask that question and ask why they don't model it that way. Because then we might understand they might have a reason. But certainly, the way you've built this here, it shows that with reinvestment, then pension savings are more interesting.
Yes.
Okay. Do we have any questions from the audience at this point? Certainly, something that would be worth doing, David, is probably using more realistic figures for the returns of the past 20 years. Is something we could do right away so that we see what kind of results we get and whether this
we can look
advantage is interesting still. I guess there's also the question of whether we should include the cafeteria plan. Yeah. Let's do let's put actual returns for bonds and stocks in the past 20 years. So 2.3 and 8.3 or 8.29. Yeah. And then what would be a decent return for long-term, like for pension savings plans? Should we pick something like 5? Does that make sense? Or
It's not me that can decide. It's really.
Lynn says 4. But let's go with 4.5 then. We just,
Yes.
the truth is we don't know, right? Because everyone will
Yeah,
have
we
a
don't know, but
different
it's just,
return there.
but it's the same for the ETFs. We don't know what will be the future, the
No,
next
but we
20 years.
but we know the past, right? So now we're
Yeah,
looking
we know
at it using the past 20 years of data from both.
Yeah.
And certainly using ARPE doesn't make sense because most people don't have that one, or they got it only after it had good returns.
I will try to just to look if I took Git. It's really difficult, but I
Yeah, we
should
get 10 years.
eliminate all the, yes, we have only 10 years. And
so the second best one is like
4.14, but like I said, it's already below for the last 10 years, so it's difficult to.
Let's go with 4.5. Look, just go with a certain number. Everyone will have different ones. Let's go with 4.5.
Yes.
The rest stays the same. Let's go without cafeteria, plan cafeteria. Okay. Let's go. Yeah, I think.
And I don't know if you want
Let's keep the 30% because I am in favor of people having bonds from the start. So I think it has other advantages that people maybe not see, but I think this is right to me. Let's go with this and see what the results are.
Yeah, maybe bring 7% here because 5.7 is quite low. Let's not change that. So without reinvesting, we see that here so it's 70,000, more than 70,000 euro in favor of
ETFs, of course. Yes.
investing in ETFs.
Yeah. And with reinvestment?
And with the reinvestment, yes, we are below at 31,000 euro less.
So this is so ETFs are still good. Is that right? In this
yes,
one?
but I will look at what age you should start.
Yes, I think that's quite interesting.
At 52.
So in this specific case,
yes,
with the new numbers for the past 20 years, starting at 52 is the optimal age for pension savings with the reinvestments, right?
If you consider that you will only reach 4.5% in these funds.
Yes. And now let's add the cafeteria plan, because this might be the biggest difference here, right? All of a sudden we add a bunch of cash.
So by reinvesting it, so yes, we see that now we are only at minus 10,000 euro after 40 years.
Yeah, and so there's the age where it makes sense to start again. Then becomes more interesting.
44.
So from 44 years old, it becomes interesting to start investing in savings plan.
Yes.
When you have like in this kind of with the specific data, right? 4.5 for the pension funds.
Yes.
And the numbers that we know for index funds, and including plan cafeteria.
Indeed.
Okay. So with those numbers, it looks like it does make sense to invest with reinvesting rather later in life, and with plan cafeteria is like almost 10 years earlier. So the biggest difference that is basically between all these with this comparison is basically the returns that we use for the model, of course.
Yeah, it's
guess
really the biggest impact. It's the most difficult to guess. So we can only look at the past.
Yeah, like can we keep it like it is now, but go and put 5% for the return of the pension funds? See what 0.5% does here. Because basically this is the one that we have very little control over. So
here, if I put 5%, it makes sense to invest even starting at 25, because we will be at more or less 6,000 euro more at 65.
Oh yeah.
But the optimal
It's from the beginning then.
Yes,
Oh, no.
the optimal is to start at 36. The year of 36.
So 0.5% makes also a very big difference.
Indeed.
Almost again, like 8 to 10 years, not just as much as. So it's really mostly dependent on, because in the end, index ETFs, the returns are going to be what they are. And most people are going to be getting more or less the MSCI World return for the stocks and some kind of bond returns. So for bonds. So I guess the biggest differentiator here there's two things. There's the cafeteria plan, the plan cafeteria, and the returns that the pension fund actually gets people, right? And that's not something we can predict in advance. But yeah, I'm trying to figure out like how does this help people make a decision? Certainly, the model allows people to get a sense of whether, well, first of all, I don't think we should even look at the scenario where there's no reinvestment because most of us are already investing in ETFs. But for those who are, basically, I think what this model shows is that the returns from the pension fund matters a lot, and we can't predict them in advance. And so it's really about, okay, what's inside these pension funds? Like what makes our pay so good? David, have you looked into this?
I will say first is that there is no entry fees, even
That
if
plays a
the
role,
entry
yeah.
fees are less impact than ongoing fees, management fees on the long term. For the rest,
Is it because it's like maybe it's a fund that actually tracks an index, like close to the MSCI
no,
World?
no. It's you have to choose, let's say, a dynamic fund, because otherwise, of course, the part of the bond will be greater and the return on long term will be less. For the rest, it's difficult. If I look at the 5 year, it's not the best one. 3 years, it's really it changed through years.
Yeah.
So it's actively managed fund, so it's difficult to predict the performance of the fund manager.
Yeah, this is tricky,
It,
right? So it looks
it
like the main predictor of performance for going into this pension fund is the performance of the fund.
yeah.
And we can't tell this in advance. Certainly, we want to be more aggressive. So, because the money is blocked there anyway, so it's not like we're not going to be panic selling in the middle of it. We want to have maximum exposure to stocks and be more diversified and the lowest possible cost. I guess these are the main criteria. And then, even in like with the numbers that we were using there, it looks like starting from 20 or 25 is too early, right? So that's not something people
Yes.
should do. But starting later is usually more beneficial, right? So for sure, if you start at 52, in almost all cases, that will be beneficial. Starting at 44, maybe in some cases, if the pension plan is actually performing really well, or if you have something like Plan Cafeteria, which allows us to have even more cash to invest, which makes the pension plan even more interesting, right? So that I would say these are the main things. But does that make sense to you, David?
Yes. It's
And certainly, I think what we were starting with in terms of what the goal was is to show that there are times where, and there are situations where investing in this pension plan makes sense. And I think they are related to, well, yeah, one is difficult to manage, which is the pension plan return itself. But basically, if you do have a plan cafeteria or some other advantage, or if you have an additional tax deduction from the city you live in, right? So in this case, you put 7%, then it might be, basically the case becomes more interesting to do. Does that make sense, David? Yeah.
Yes, I think you have to simulate with your personal parameters. That's really the conclusion of this presentation.
Yeah.
Try and look at the results. It will give you just an incentive of if it's interesting or not to invest in these plans, and probably not just look at what you read in forums. It's a response, average response, yes. If you have 30, yes, probably that will not be interesting to invest in pension savings. If you 45, 50, it can be interesting to invest.
Okay, I think this is good. Are there anyone with comments or questions? So maybe you want to take a look at the chat. There's a question here from Anne. Does payment make a difference monthly or once a year? I used to pay in January. As they say, the performance is longer and better.
Yes, so it's better to invest in January. Why? So they make simulations on the last 20, 30 years, where they invest each year the best day. So it's when the market is at the lowest point. And so they get a higher threshold of what you could reach. Then they do it by investing in the worst day of the year. So when the stock market was at the highest point. And so they get two thresholds, and then they make three, let's say, real investment. So investing the maximum at the beginning of the year, investing at the end of the year, and investing DCA. So each month 1/12. And they see that by investing at the beginning of the year, it's where you reach the maximum amount possible. Because in general, the stock market is increasing. So it's like investing ETF, a lump sum has a bigger probability to reach a bigger portfolio after a certain amount of years.
So here the question from Anne is this is investing in the pension plan, right?
Yes.
So I'm thinking about this because basically it depends. So if the alternative is you keep cash in your account and you wait for later in the year to put it in the pension savings plan, then it's probably better to put it all at once up front. But does that make sense, David?
Yes.
But then if you say have 500 euro to invest each month, it might be better to actually invest later in the pension funds and invest in index ETFs in the meantime. Basically, it's not like it depends on what is the alternative to the pension savings plan. That's all. That's what I'm saying.
I will say that in general, it's difficult like this to really give an answer, but you get an advantage by investing early because the capitalization of your deposits for the tax only starts the 1st January of the next year.
Oh yeah.
So
but
if
the
you invest,
the real returns though, they kick in right away.
Yes. So if you invest the 31 December, it will directly start capitalizing. If you start the 1st January, you have like a free year of.
But that is for the purpose of the 8% tax at the end.
Yes.
So it's a nice optimization, but for a minor advantage. Does that make sense?
It's an advantage. Maybe it's difficult if the funds perform bad this year and the ETFs perform well. Yes, it makes sense to start investing in true ETF.
Well, no, most of the time they will both move more or less in the same way. Right.
In general, yes.
Let's be clear, on average, no, they will. So
yes, we can see that more or less, but it's suboptimal to invest through pension funds.
Yeah. So basically, if the alternative for your money is to just stay in cash, then put it in the pension fund early in the year is better.
Yes.
If you're investing also in index ETFs, then not necessarily, because who knows what could happen between the two cases. I just want to be clear. This is because the bank probably tells Anne and everyone who's doing this that they have an advantage in doing this early. And I want to emphasize that is if the alternative for the money is to stay on the bank account with the very low interest rates. That is not the case if the alternative is to be in ETFs, right? Let's just be clear there. But then again, one might do better than the other by a tiny percentage over a year. So whether you should do the pension plan first or the ETF first on January, there's no fixed answer.
Just be careful at 60.
Okay, so banks advise monthly. Okay.
Yes, because they consider DCA is the best for people.
Yeah.
Just at 60, be careful to invest after your anniversary. Just for the deposit of this year, not taking it into account in the tax.
Can you explain this a little bit, like for anyone who may not be turning 60 now, but like why, how to handle that?
So the way they construct the basis to apply 8% is they put it each year the amount you put, and they start capitalizing at the beginning of the next year. So when you reach 60, and let's say that you're born the 1st March, if you invest the 1st January, 1,020 euro, it will be added in the basis, and so you will pay 8% of this 1,020 euros.
So on the year of your birthday, say I'm turning 60 next year in 2025.
Yes.
And I say I turn 60 on the 1st of May, which is my actual birthday.
Yeah.
It's better for me to invest after the 1st of May.
Yes.
Because then it will not be taken into account for the 8% tax.
Yes.
So on the year of your birthday, contribute to the pension savings plan after you've turned 60. So on the year of your 60th birthday, contribute to your pension plan not before turning 60, but after, so that the 8% tax is not applied to that contribution. Okay, I think we've clarified super well. Does that make sense, Giovanni? Yes, I think it is. Okay. I think you got it too. Okay. So for example, say someone is 58 now and have a pension plan, what would you do? Keep it or drop it?
Certainly not drop it, because you will have to pay a penalty tax of 33% on the amount.
Yeah.
So it's not advised to.
No, not drop it, but like if you stop contributing.
Stop. But
say someone has been contributing since they were 30 or something. So it wasn't optimal, but now they're 58 and have 2 years to go.
58.
Do you stop? Do you stop putting money in there? Should we continue? I'm saying 58, but
50,
like
58, I mean, yes, probably they should invest, because it's really close from 60.
But then think about this.
He already start investing in pension savings.
Yeah, so assume it's someone who's been investing already for 20 years in pension savings plan.
Yes.
Right? Let's imagine, I don't know if it exists already since 20 years, but basically someone who's close but have clearly started, and it maybe wasn't the best way of investing back then compared to ETFs. Like, what do you do when you're close to it? Basically, that's probably the situation of many people. They already have one of those. Should they stop contributing? Should they continue? Like, how would you navigate this? It's a bit of a different question than when to start, which is what we're looking at here, right? It's for people who have already started. What should they do?
If they already started, I will run through simulations and I will look what were the results for my personal situation.
So we would still have to model it in a specific way, right?
Yes.
And if someone is really close, like it's only, just a few years left, feels like completing it makes sense for the sake of completion, but from a return perspective, it's not the best use of their money, right? Because the tax.
The last simulations we did.
Actually, no, you're right. So every contribution after the age of 52 or 53 or 54 was good to do.
Was good indeed.
It's just all those that were there before that weren't necessarily good.
Yeah. Maybe just
anyone who's like 55 and above seems like, even if it wasn't right to start 20 years ago, continuing now makes sense because all contributions now benefit from tax advantage quite a lot.
If you start at 25 and you realize that it's not worth, maybe stop and And wait until, yes, 40, 50, depending on your situation.
But then if you're 55 and you've been contributing to it, don't stop, because now is the contributions that make the most sense, because these contributions will benefit from the tax advantage more, and they will not be invested for as long as to basically, lose this benefit through lower performance or higher fees. So it makes sense to certainly, like from somewhere between 50 and 55 and above, to actually contribute to savings plan because of the tax benefits, even whether you were contributing or not earlier, right? It doesn't matter so much. In the end, that's also what your analysis of the last 2 pages show, right? Is that each year can be taken individually to see whether it's worth contributing that year. And above 52 and 53, it was yes for, I think, all the cases that we've looked at. Apart from the very worst, or something, there was one where it didn't make sense.
Even without reinvesting, yes.
But we're talking to everyone, like, let's imagine everyone is reinvesting, right? So I think the worst we've got is like from 52, in all cases, continuing.
Probably at 58, you will have an advantage of.
That's for sure, almost, no? Because it looks like over 2 years, you don't have time to lose the benefit of the tax advantage.
Indeed.
Okay. Okay, maybe there's more questions in the chat, but I wanted to say one more thing. It's not just about the returns. I think this is what I wanted to say. Whether to invest in the pension savings plan or not, there's a lot of other factors around this, right? There's the fact that you don't have access to it until a certain time, and then you can, but with a penalty. So for some people, actually, for most people who do not know how to invest in index funds, this is a good thing to do. Do you agree with that statement, David?
It's better to invest in pension savings than put your money in a savings account.
Yes, or try to pick stocks in most cases. But so that's one thing, no? And the other aspect is, like, it's kind of a forced saving vehicle, which is quite nice because taking the money out is complicated, which means that people will have money at the pension, a very small amount, right? So that's a benefit. And if you feel like it's hard for you to keep your money invested in the stock market, then maybe this is a better way. That's what I'm saying. There's a benefit of not having access to it easily. For most of us, that's not the case, but there might be cases where you just can't help but sell your stocks at some point to spend on something. If that's a problem, then investing through these kind of pension plans prevent you from selling easily, right? Now, a drawback, though, in investing in savings plan is that you don't have much control over it, right? So it's fixed asset allocation. You don't have access to ETFs, that kind of stuff. It does not really depend on the Belgian pension system. Well, it does a little bit. Like, the rules could change, right? Taxes could change. We don't know, right? So if I'm 40 today, or not yet, but next year, if I start investing in this, who knows if the tax at 60 will be still 8%, or if it's not going to be more. I don't know, right? So there's uncertainty around regulations.
It has already changed.
Okay.
And it's only on the new deposit that's the law can be applied. So
yes, makes sense.
The deposit of next year will be taxed at 8%. If they choose to increase the tax at 10 or 12%, it will be only when the law will be on. Yes, indeed, and the law can change, but it's the same for the, I think, ETFs.
It's true, yeah.
If I look at the government now, we see that they speak about a tax of 10% on capital gains on stock.
Yes.
I think that the government has some issue with the first pillar. It's really difficult for them to maintain the system. So it makes sense, I think, to believe that they will push people to invest in second and third pillar. And they also realize that the cost, really the management fees and the entry fees are very high. This year, the FSMA released a simulation of how much cost do you really, you pay over 20, 30 or 40 years. So for me, I don't think that they will allow banks or insurance to continue increasing their cost. It's my opinion, and They probably
they're
force the banks to decrease those type of costs. Where for ETFs, I'm afraid that tax on capital gains will be implemented.
Yeah, which will apply to any stock investment, including these, right? And in that case, then maybe this tax advantage can become even more interesting. The way I see this tax on capital gain, since we're on the topic, is that if they implement it, they will also probably make tax advantages account like this one even more interesting, because you're going to have to give some kind of way for people to invest for the long term, and having some kind of benefits on those capital gain tax will be interesting, I think, as part of this. But anyway, it's a separate discussion. We have another question here from Tom. So let's assume that you stop at 45 contributing to these plans and you start again at 55. What happens to those 10 years gap? Is it calculated and applied? This 4.75% return, is it applied to this as if you had, or is just applied to the amount that you've invested on the years that you did?
So if I understand well, you invest until 45, then you stop between 45 and 55, and then you start again. The amount you already put will be keeping growing, and for the tax, it will be capitalized at 4.75% each year. During 10 years, you will have no deposits, so the basis, there is nothing that will enter, no fresh money in this basis. And at 55, it will start again, and you will put money, and at 55, you will have 4 years of capitalization. That's it. Just be careful that for the simulations, you need to start before the age of 55, because the contracts is for at least 10 years. So if you start after 55, then you will be taxed at 65. And then you will lose the fact that at 60, when you pay your tax, you can still contribute it without paying any tax.
Yeah, so this is another assumption, right? Is that the model works only if you start investing before 55.
Yes. And also it's a new law, it started 2 years ago, I think. Between the age of 50 and 54, you need to be careful of the amount you put in these pension savings plans, because if you put only, let's say, 100 euro, after 55, you cannot put more than 100 euro. So it's the maximum between what you put in 54 and the average between 50 and 54.
Between 50 and 54,
you need to be
the
careful
best is to put the right amount, like 1020.
The maximum. Otherwise, if you invest more after, the bank, the state will consider it as a new contract, and so they will delay the tax.
Oh my God.
After 10 years.
Okay,
but
great.
Just the fact that you need to be aware. I don't know if the bank sent letters to people when they reach 50 to warn them about this. It's basically just controlling how much you.
Okay, so we have another question. Oh, no, that's all. There's some other comments. Yeah, is there a pension fund with all world MSCI, world ETF and bonds?
For banks, I don't think so. For insurance, it exists, but when those type of contracts, you will have to pay a management fees of 125 and between 125 and 1.5% each year, which cancel the fact that you invest in an index fund. We ran a simulation last week, and we see that it was not more interesting to invest in this one than in a bank fund. More, and on top of that, you cannot benefit from the no, in fact, yes, you can benefit. No, so it's I don't think it's more interesting to invest through an insurance contract. You have to look at the performance of these funds. Yes, they say that they will follow the MSCI World, but when you look at the performance, because they eat 1.5% each year.
Yeah.
So,
and what's the ongoing management fees for ARPE?
we have to look. I think it's 144%. It's
Wow,
possible
okay.
to. It's difficult. I advise people to really, when they want to look at those kinds, to really go in the KID, key investment document. And in those type of, you can find here, if you invest 10,000 euros, you have to pay 144 euro per year, so it gives 1.44%.
Yeah. Yeah, so it's
Because you
quite
can,
high and still managed to do good results. So
yes.
interesting. Okay. Anyway, this is past results, so we don't know if it's going to continue. Okay, look, this is really interesting. I wonder if there are any final questions or if you have any final message.
No, so I think the conclusion of this presentation is to run a simulations and to look at what is best for you.
Yeah, so for that, you've made a really nice model here. So everyone, I encourage you to download this. We've shared the link before, and feel free to edit. And if you have any suggestions, don't hesitate to write to hello@firebelgium.com, and I will transfer that to David. The goal is to improve the tool so that it's helpful for more people. That's kind of what we're trying to do.
Just a small remark: if you already invest in a pension savings funds, maybe it's to go to Liegeois or the Tate, where you can find really the net asset value and the NAV, so the value of one share. And so you can find for let's say 20 years or 10 years, it depends what you want to take as a return, but you can find it on this site.
Mm-hmm. There's a few people saying thank you, David, and I want to join them and say thank you so much for all the work you've done. Thank you for the presentation and explanation. It's a lot of work. It's a lot of detailed, like Excel work, and so it's really nice. We're gonna try to do more of this.
We will improve.
To improve it, right? And then
yes, because for example, here in pension savings, I didn't. So for the 60 years, I put it as you were born on 31 December. So here we can improve it by avoiding paying at 60. Also at 60, what we can do is to sell. Sorry?
I think it's okay. There's minor things you can improve. And
yeah, no, but we can sell.
We
can sell the portfolio and reinvesting it in ETFs at 60.
Yeah, that's
which
something
will
we need to do.
also give more value of the pension savings.
Yes. Okay. I think I'm gonna adding this to the notes. Yes, so these would be more realistic scenarios, which is what we need to do. Okay, everyone, thank you so much for this. Yes, there's an event happening actually on Sunday, this Sunday, 15 of September in Ghent. I won't be able to join because I'm at a family event, but Toon and Will be there, and it will be in Dutch and in English. Right. Thanks, everyone. Good night, and see you around.
Bye.
David, thank you so much. I'm going to start recording.